Welcome, everyone, to another episode of Ben's MicroVision podcast, a podcast for general information and entertainment purposes only, not a financial advice podcast. In this episode, we're going to take a look at a letter from the CEO having to do with a reverse share split that we voted on, and it got approved, and now it's going to be executed. So we're going to look at what this means for folks like you and me who are holding the shares, and take a look at what the new capital structure might help support for the company going forward. So let's get into it. All right, the news of the reverse stock split was accompanied with a letter from Glenn. I'll take a minute to go through it and we can talk it over. To our shareholders and stakeholders, today we announced our board of directors approved a reverse stock split as authorized by shareholders. I want to explain why we took this step now, how it fits into our long-term growth strategy, and what it means for the continued transformation of our company. The strategic rationale. As we execute our long-term growth strategy, maintaining our NASDAQ listing and achieving a healthy stock price are critical enablers. Effecting the reverse stock split now is expected to allow immediate term compliance with NASDAQ's minimum bid price requirement, thereby reducing ongoing listing risk and removing a significant distraction so that management can stay focused on strategic execution. Also, doing the split now is expected to improve the investability of MicroVision stock with a stronger price, reduced volatility, and sufficient liquidity to support a compelling investment opportunity. The reverse stock split is not being undertaken because we believe it creates value by itself. Shareholder value will continue to be created the same way it always has been, winning customers, delivering products, growing revenue, expanding margins, and executing consistently. Our strategy is transforming our company. Over the past year, MicroVision has undergone one of the most significant transformations in its history. We're no longer pursuing a single market opportunity or relying on a single product. Through disciplined execution and strategic acquisitions, we have built one of the industry's broadest perception portfolios, spanning automotive, industrial, security, and defense applications. Today, MicroVision offers multiple LiDAR architectures designed to meet different customer requirements, industry-leading perception software that enables customers to deploy solutions faster and more efficiently, engineering teams across the US and Germany with decades of experience in automotive-grade development, growing commercial engagement across industrial automation, robotics, security, defense, infrastructure, and automotive markets, expanded semiconductor and ASIC design capabilities through MicroVision Semiconductor. Letter goes on to say, focused on execution, confident in our future. Our mission remains unchanged. We are leveraging our expertise in advanced sensing technologies to build a diversified perception technology company focused on solving real-world problems with scalable hardware and software solutions that deliver sustainable value for customers, shareholders, and all our stakeholders. To our employees, thank you for your commitment. To our customers and partners, thank you for your trust. To our shareholders, thank you for your continued confidence as we drive the next chapter of MicroVision's growth. MicroVision shareholders have supported the company as we've expanded our technology portfolio, integrated acquisitions, entered new markets, strengthened our engineering capabilities, and repositioned MicroVision for the next generation of perception solutions. We do not take that support for granted. The opportunity before us is significant, and we remain confident in our future. Our focus is clear: execute our strategy with discipline, serve our customers, and continue building a stronger, more diversified company for the future. Obviously, to the many people watching this who put hard-earned capital at risk in MicroVision stock, seeing this is a less than welcome development. I can only say my feeling about it is this is the bill coming due for the lack of progress that was made over the preceding few years commercializing MicroVision's technology. And, you can't just go and and lose tens of millions of dollars every year on end without growing your top line. And when that's what happens, essentially, you hit the wall. And my feeling about it is this is a total restructuring of the company's capital base. And this is the cost of the lack of success that we had between 2020 and 2025. And, we never got the product market fit. We never got the customer wins. And so we built technology, we built products, we did demonstrations, we did a whole lot of things. But what we didn't do was build a sustainable revenue base and find the products that fit with the market and all those things. So I guess it boils down to, if we believe that under Glenn's leadership and with the new portfolio, which is pretty broadest in the industry, they're going to be able to essentially execute a strategy that has a good chance of success where the previous strategy didn't. But at the end of the day, this is where we find ourselves. So let's take a look at what this might mean. All right, so here's a little chart that should help explain the nature of the capital restructuring. Now, I use the value from Yahoo Finance for shares outstanding, which was 344.65 million shares in the pre-reverse split world. So in the left-hand column, you see the pre-reverse split. So after they execute the reverse split, there will only be 22.9 million shares. Maybe we round it up and call it 23. But that's the difference there. So from 344.65 down to 23 million shares. Okay. In the pre-reverse split world, the previous cap on shares available for issuance was 510 million. Okay. So something about, on the order of 150 million more shares than existed. Right. Now in the post-reverse split world, there's 150 million shares beyond the 23 million that would be issued. Okay, so you now have 127 million shares available for issuance. Now, of course, everybody kind of freaks out. Oh, they're just going to dilute us to smithereens, right? Well, we don't know that. Like, there's going to be some form of share issuance to raise capital. But they're not necessarily going to do it all at once. But then this next column is, I think, kind of what the crux of the issue really is, which is, let's just say they didn't execute this reverse split, and for whatever reason, the share price stayed low. You got to remember, these guys did absolute blitzkrieg on announcements over the last, couple of weeks. But I think generally speaking, the market just kind of shrugs their shoulders because this situation, this dynamic, kind of overrides anything because everybody knows what the deal is. So if you look at the deal in the pre-reverse split world, the balance of shares available for issuance, that 510 million over against 344 already issued. That at 30 cents, if they tried to issue all of them, they could only raise $49.6 million. And 49.6 million, is not enough, period. So that just doesn't work. And that, I think, is really the crux of the issue. Is that now they could have said, we're not going to reverse split, but instead we're going to increase the cap from 510 million to $1 billion, right? And if they had done that, I guess that would be okay. But $1 billion shares out, I don't think that would be a good idea. So really, what do? In the post-reverse split world, right, the shares gone from 30 cents to 450 because now each unit is 15 times as valuable, right? So there's 127 million available for issuance. If they blew them all out at 450, they could raise over $500 million. Of course, we'd be diluted, etc. But the point is, there's more than 10 times more capital available for the company, even at these, insanely depressed prices. Now, would they raise $500 million at 450, which is about, 100 million cap? No, they wouldn't. But the point is, this shows the headroom that they didn't have in the world of, pretty much today, and the headroom that they will have after they execute this. Now, of course, this all comes at a cost for folks like you and me. But the other part of the math is, like, from a percentage ownership standpoint, right? You are unchanged. The only time your percentage ownership is really affected is when they do go to market and try to raise funds with the new capital structure. So their new headroom of 150 million is what's going to make, our ownership percentage be reduced, right? And I had said in a previous episode, which I think kind of rubbed people the wrong way, at least some folks, if you're concerned about the effects of a dilutive capital raise, then I use the term pony up. But what I meant is you can participate yourself in that dilutive capital raise and maintain your percentage ownership, assuming you have the cash available to put at risk in order to do this, right? So that's everybody's decision. But, ultimately, since the costs exceed the profit margin on the sale of products and services, they got to fund the company until they can break even. And they're going to do that through share issuance, among other means. So if you're really worried, I have to keep my percentage ownership. There's only one answer for that. And you could say, well, they should have done whatever to give me a warrant or, give me preferential rights. Maybe. The arguments are there, and I'm sure they're fine, but this isn't what they did. So now you have to make a different decision. And that's for everybody to decide, what's the prime directive? Some power is meant to sleep. When you order from Laser Roasted, we awaken it. Heat, precision, transformation. From first crack to first pour, freshness you can taste. Roasted to order. Get yours today at laserroasted.com. All right, so, there's valid business reasons for people to feel upset and regretful and all of the tough emotions that come with, not being on the winning end of things, at least yet. But probably it's a good idea to evaluate, what's new and changed, right? If we imagine that the arrow on the right-hand side of the chart that goes up and to the right is illustrative of a compounding growth story for MicroVision's products, hardware, software, engineering services, all this, in a world where, physical AI is starting to kind of catch the fever a little bit. Then we can see a growth story happening where there wasn't one before, right? The prior 5 years that are shown there, this is kind of was at the beginning of my talk track, is like, okay, when you're doing an average of, 3 million a year, that's just is not going to cut it. And that's where we found ourselves sort of in that problematic situation. But now, right, there's a new sheriff in town. There's a new regime. There's a new approach to the entire thing, which is, of course, the diversified revenue base, the diversified product portfolio, and what I called as land and expand in as many markets and with as many customers as possible. So there's your new pipeline, right? We went from a handful of customer engagements to over 100 priority engagements with different customers across multiple different markets. And, in the world of today, we're kind of yet to see any of those, switch over from evaluation or, development work through into production. And so that's the world that is out there. If the products meet the need and they perform their function, then it stands to reason that people would order them so they could have autonomous mining trucks and autonomous mobile robots and autonomous unmanned ground vehicles for, military applications and the drone surveillance systems, all this stuff. Like, it makes sense. It's just on its face, it makes sense that these kinds of products will be part of a new wave of adoption. And I think that's what, companies banking on, and that's why they put the arrow up and to the right. All right, MicroVision also provided this chart that shows the TAM, total addressable market for perception solutions, growing from a little under 10 billion in 2028 to over 40 billion in 2035. And it shows the three segments: industrial, security and defense, and automotive. And so, with this, we have the necessary ingredients to construct a model, and models, by definition, attempt to describe the shape of the future, which of course has an unknown outcome. But we can model different eventualities, and we can look at various scenarios and think about, what they could mean, especially after the capital restructuring that we talked about earlier. All right, so let's go back to our spreadsheet and just do a modeling, because what we know is they need to raise funds. Okay, so in the world of post-reverse split, they got 23 million shares out. And in this example, we're just going to double up. So we're going to issue 23 million new shares at $4.50 each, because that's the current price, just for the sake of argument and discussion, right? Maybe they can improve this, but just in the world of today, if there was no improvement to the share price prior to the fundraising, and this is an example of what this could look like. So they issue another 23 million on top of the existing 23 million. And in so doing, they raise $103 million in cash. Okay, and it gets us to 46 million shares out. So in this world, if you don't participate in the raise, your percentage ownership is cut by half. So you own half as much of a company that now has $100 million war chest, which would be a much more advantaged position to be in, assuming that they can, continue to grow that top line and keep the margins intact. So in our world, right, we're just going to model some scenarios. 46 million out, companies well capitalized, 100 million in the bank, plus whatever they had already, is somewhere on the order of 30 million or so. So 130 million should be plenty for this team to go and execute the plan and get to break even and beyond, at least as I feel, right? They haven't come on the show and said, this is our targets for break even or anything like that. So this is conjecture, but it's, I think, well-supported conjecture that they could basically never have to do another dilutive share issuance if they followed a plan that looks something like this. And in a world where they never have to do another dilutive share issuance, some of the overhang that we've all experienced, might go away. So again, don't get mad if you don't like that they issued 23 million more shares in my hypothetical scenario. The only thing we know is there's going to be some amount of shares issued at some price to recapitalize the company and give them the runway they need to execute the plan. So, in the best of all possible worlds, they announce something great and the price shoots up and they only have to issue a fraction of that to get that same 100 million, right? So we'll see. And I don't know what the target is for capital raise. Obviously, they've done small drips and drabs and have at the market facilities and stuff like that. I don't know what they're going to choose to do. In a world where they're just ripping the Band-Aid off all the time, in order to kind of get everything bad out of the way, right? We're going to mark our inventory as obsolete. We're going to get rid of the Redmond lease. We're going to just take the pain now so we don't have to take it later. Take the pain of the share issuance now so we don't have to take it later. I don't know. I defer to these guys. They know what they're doing. But these are the variables. So we got to model something. So let's just use round numbers. All right. So if we know the TAM goes from 8 billion to 40 plus billion in 2035, then the question is, given MicroVision's portfolio, given their team of experts and their engineering skill and the new commercial organization that Bune is going to put in place, we're going to have to assume a certain amount of penetration, right? So in the first year of this, 2028, we're going to say 1 out of every $100 spent on autonomous system technology, which is really the market that this company is playing in, is going to go to MicroVision. They'll be able to penetrate 1%. So for every 100 autonomous vehicles of any kind, one of them will feature a MicroVision perception unit, right? If they're going to be successful, they're probably going to do better than that. But for the purposes of staying grounded, we're going to use these numbers. 1 in the first year, 3% in the second, which is 2030, and then 5% in the 2035, right? And there's going to be growth in the TAM, and there's going to be growth in the penetration rate because MicroVision will build the customer base. People will ask for it by name, all these things. So 1% into 8 billion gives you 80 million. So that means MicroVision will make 80 million if they penetrated 1% of that addressable market in 2028. If the margin stays at 40%, that means their product profit would be 32 million. And interestingly, this is very close to what I had modeled in the journey to profitability that I did several weeks back. So I did 10 million, I think it was 10 million, then something like 30, it was 12.5 million. I did 12.5 million this year. Then a 3Xer gets you to 37.5. Then a 2Xer gets you to 75. And another 2Xer gets you to 150 by 2029. So that was my initial model. So now we have the TAM for 2028 of 8 billion. And we go, okay, let's put in 1%. Well, 1% gets you to 80 million. It's pretty close to 75. In any case, the margin of 40% on 80 million in sales would be 32 million in product profit. Now, in the earlier bit of the show, we said, what about 46 million shares out to recapitalize the company and get the whole thing sorted once and for all? So almost once and for all in this model. But in any case, we're going to leave it at 46 million through 2028 and assume that that 100 million that they raised, gets them to this point. If it gets them to this point, let's say they still have 65 million in costs for the engineers and the offices and sort of run the business costs. So that means they'd be in a deficit of 33 million. So if you penetrate 1% of 8 billion at 40% margin, you're going to generate 32 million in product profit. And if your run the business stays the same at 65 million, now you've basically had to burn 33 million to produce that. So your profit per share in this scenario is minus 0.72. So I don't want to put a PE ratio or price to sales because I don't really know. Like, we can't imply what the share price would be, but in this scenario, they would have gone from 12.5, which is a mid-range of this year's guidance, to 80 million 2 years later, which would be pretty significant. So we can argue whether or not the share price will go up ahead of profits, assuming the top line goes up. Probably that would be the case, but we don't know. I can't really model it. So we'll save our modeling for the next couple years out. In the next year's 2030, and looked like it was 18 billion on their chart for the TAM. So if they now do 3 out of every $100 goes to MicroVision for perception systems, that would get them to 540 million in revenue, which is 3% of 18 billion. If they have 40% margin, that means their product profit in that year will be 216 million. All right, we're going to bump up the shares outstanding because maybe, the executives are getting grants, and as we've seen, the board of directors are getting grants. Everybody's getting grants. But, for the purpose of round numbers, we'll call it 50 million by 2030. Let's assume the run the business costs increase incrementally, not drastically. And they go up from 65 to 75 million in those, 2-3 years. Okay. That gets you to an overall MicroVision profit of $141 million. If they have 3% of the TAM and they keep the margins at 40%, then they make $141 million. How'd you like to see that? So if the shares count gets up to 50 million in that world, then your profit per share will be $2.82 in 2030. Okay. So what PE to put on it? I don't know, but we could say between 25 and 33 is appropriate. And that would get you to an implied share price of $70 to $93 per share based on that. Okay, pretty nice, right? If they succeed 5 years later at increasing their penetration rate from 3% to 5%, which is still like 1 out of every 20 perception systems is a MicroVision system, right? I don't know if their TAM, as they calculated it, excludes China. Probably, I would guess that they did that. But, would a large conglomerated perception company that has every type of perception modality only be able to penetrate 5% of the Western market? Like, I don't know. Probably they might be able to do better, but we're just going to do 5%. So in 2035, I'll be walking with a cane, but that's okay because they will make 2.1 billion in revenue, which is 5% of 43 billion, right? If their margin stays at 40%, then their product profit would be $860 million in that, farthest out year. If the shares outstanding increase to 60 million because of the grants and whatever, maybe they raised funds or did something special, and their run the business costs increase from 75 to 100 million because now there's a new office on the moon or whatever. Then the overall profit would be $760 million, right? Which is your 860 product profit minus your run the business costs. So if they profit overall 760 million, then their profit per share, if they increase the share count to 60 million, would be $12.67. And if we imagine the PE that's appropriate for the company would be, call it 20 to 27. Like, we don't know. It could be anything. Then your implied share price for that would be $253 to $342. Now, you can't just go and take this to the bank. Obviously, we could have modeled a lot of stuff over the history of MicroVision that we thought was going to happen and didn't happen, right? So the question is whether really it is a new day for the company under the new leadership and with the portfolio strategy and with the diversified segment strategy and with the kind of land and expand approach that I believe that they're taking, and with the new chief commercial officer and all this new stuff. Like, the company's been reborn, as the board said during the proxy conversations. And, I think it's true. The changes in approach are kind of self-evident. Does that mean they're going to get 5% of that 40 billion? Like, I don't know. Do I believe the 40 billion is a good enough figure? I think it's probably fair. Physical AI should become the next wave of technology after people get sick of data center based AI and, hallucinated responses and, agents that screw things up and all that stuff. And they want somebody to do physical labor or move something from one place to another, or just sit back in a car that drives itself and gets them to where they're going, and reduces accidents on the road, right? Overall efficiency of operations. Like, the story sells itself. So the question is, how effective will MicroVision be in penetrating those opportunities and converting some of the stuff they've already got in the hopper into a large recurring revenue base that they can build on? All right. I do want to say thanks so much to everybody for watching the show. Thank you for your kind comments. Thanks to everybody who is a channel member. Thanks to the folks who buy on Laser Roasted. I've seen the reviews. People love it, and I'm so appreciative of that. So thank you very much. I know this has been like the toughest time. It's been a tough time for yours truly. The people who have really believed in these guys have had a rough go. I guess the question is like, a broken clock right twice a day, or does a blind squirrel get a nut, or whatever analogy you might want to use. Eventually there's a time when things come together for the benefit of the people who have believed all along. And, I don't know when that moment is. It's been a rough go. There's a lot of forces that are arrayed against the company. There's short sellers and other types of people who want to see the company fail. And there's the company's own kind of missteps that we talked about earlier, right? So product market fit and penetrating the TAM and building the recurring revenue base and these things, these are the vital things. And will Glenn find a way to connect the company's portfolio to customers that want to buy it? Like, that's the bet, right? And so the cost we've had to bear is getting our share count reduced by 15x in order to reset the table and reset the chessboard for Glenn and his crew, so they've got headroom and the ability to recapitalize. So that's how it all shakes out. Like, nobody said this was easy. It's not easy. And, this is where we find ourselves. If they recapitalize and execute the plan, we'll all be, drinking Mai Tais on the beach. But, it's an incremental process. So they got a lot of milestones to achieve, a lot of hard work to do. So if we believe these are the folks that can pull us over the line, then all we got to do is sit and wait. And if you really care about getting your percentage ownership diluted, there's only one thing that you can do to solve it. So don't get too mad, but that's just how it is. So anyway, thanks again. We'll see you next weekend.